Good morning and good afternoon, everyone, and welcome to SRP's latest virtual panel, which today will be focusing on ESG investing in Asia Pacific. It's a hugely timely topic as there's growing awareness of ESG in Asia. Our panelists are also going to be very busy discussing this and answering lots of questions, so they'll have a lot to go through. So I'd like to start by introducing our moderator today, Daniel Gerard, Vice President, Senior Multi-Asset Strategist, Asia Pacific at State Street Global Markets. For everyone listening, you have the ability to ask our speakers some questions, so please do throughout the webinar. Guys, thank you very much for lending your expertise to us on this topic. Over to you, Daniel.
Thank you. Good afternoon, everyone. Thank you all for joining us. Thank you to SRP for organizing this very timely webinar, and special thanks to Emily in London, Jack in Hong Kong for putting together this great panel. And before we start, I just thought I would introduce the speakers. So first we have Christine Chardin, who is the Executive Director product at MSCI. We have Isabelle Millat, Head of Sustainable Investment Solutions at Societe Generale. We have with us Marc Lancelot, Managing Director, Head of Managed Solutions of Balance Sheet Products and Investment Governance, Wealth Management at DBS. And we have Juliette
I think we may have lost Daniel. So just please bear with us. Sorry about that. Hi, so I'm just going to take over temporarily introducing our panelists today. So we have Isabelle Millat, Head of Sustainable Investment Solutions at Societe Generale Corporate and Investment Bank, Juliette Macrezi, Head of Greater China and Southeast Asia Markets at Vigeo Eiris, Marc Lancelot, Managing Director, Head of Managed Solutions, Balance Sheet Products and Investment Governance, Wealth Management at DBS, and Christine Chardin, Executive Director, Global ESG Index Product at MSCI. So I'm hoping that Dan has come back. No, okay. So let's see. Starting with some questions. First question, I believe that is sort of going to be touched upon today. ESG drivers could be broadly categorized into two buckets, I guess, that are by no means mutually exclusive. Number one, those who believe they're important performance differentiators. And number two, those who believe they're important marketing elements. So how have these two buckets changed over the past year or so, and obviously importantly since the pandemic began? So I think Isabelle, would you like to sort of take this question first?
Sure, absolutely. And first, hello everyone, and thank you for inviting me. Delighted to be part of this webinar on ESG today. If I may, I would slightly rephrase actually the second driver to say that some are driven to ESG because they want their investments to match some personal beliefs or environmental and social priorities. It's, you know, the do-good element of ESG investing, when the performance driver, which you mentioned, is called usually the do-well element. And I wouldn't refer to the do-good driver as simply marketing, because there is sincere appetite or even a sense of urgency for prioritizing environmental or social considerations in consumption, but also investment decisions. And then if ESG solutions, of course, deliver on their promises, if they walk the talk, then it's more than simply marketing. But that said, historically, values-based investing was the first ESG investment style.
So I believe we're having connectivity issues as Isabelle has just popped off as well. Juliette, would you like to continue on?
Yeah, sure. I guess what my point is that I will follow up on what Isabelle was saying regarding the driver of the ESG integrations. That is common to some globally, but also apply to Asia. And the first one is not only for marketing elements, as Isabelle mentioned. I think since the COP21, there's definitely a focus on the climate issues, the urgency of transitioning and acting on climate. And the large investors are now taking those topics really seriously in their investment decisions and investment models. They need companies to follow, disclose, and be transparent. So they require this transparency for all their investment, whether in emerging markets in Asia, in Europe, and Asia Pacific. So we are now, one of the key drivers is this recognition that ESG risks are important risks alongside financial risks, and that could lead to major losses for company. We've got, of course, a lot of examples in the past in the history of reputational risk or ESG risk going to bring financial losses for a company. Could be governance, could be environmental and social risk. And I would like to add some points regarding the pandemic and what we have been with the COVID situation. I think it highlighting even more the connection between social and environmental issues. So it's something that we cannot solve one without the others. So there were even before the COVID-19 crisis, there were a lot of extreme climate weather events that bring really our water or resource scarcities that are becoming important reasons for migrations. We call that climate migrations, and it led to really high social, economic and consequences for the hosting countries. So in addition, the growth of inequalities of today's world is making stakeholders more and more concerned, not only in developing a strategy of transition to more sustainable activities, but also to more sociable, equitable society. And the recent crisis, so we are still living in the COVID-19 crisis, just highlight this connection between social impact from health impact that will bring a really negative environmental impact and economic impact as well, a disturbance on the financial markets. I know that some slides will be bring forward later about the link between the performances and the ESG. And so there could be what has been recently demonstrating during the crisis is that like some ESG funds have been more resilient in this crisis than non-ESG funds. And there was as well a recent survey from from Harvard that analyzed some data from the latest financial crisis in 2008 and 2009, and they demonstrate that in time of crisis, companies with high social capital have stock returns that were 4 to 7 percentage points higher than firms with low social capitals. So yes, coming from environmental to social issues really demonstrate that is not at all a marketing topic, but is a core fundamental topics to deal with for companies. Hello.
Thank you, Juliette. I believe Daniel's back on now. So Daniel, welcome back. And I think you're on mute. So over to you. Yeah.
Thank you. Apologies for that. I'm afraid I don't know where we've left off though, because I've just joined in.
We're on question 2. So Juliette was just finishing question 1.
Thank you so much, and apologies. So Isabel, another question for you then. We will really, we're going to need to see some more evidence, most likely. Is that right, to perhaps entice customers in this region back into the ESG story? What has been your experience with creating indices, using ESG indices in products? What's been the uptake from clients? Is there room for some further localized index development and product refinement?
I don't know if we have Isabelle back on, but this is Christine Chardonnay, so I could potentially start talking about that and then hand over to Isabelle when she's able to join us. So I think in terms of performance, first of all, we're starting to have a decent amount of evidence that ESG doesn't sacrifice performance, and I think Juliette referred to some of that. In fact, year to date, and there's a chart on the following page. In fact, year to date, we have seen ESG indices have shown a lot of resilience in the crisis, both in developed and emerging markets, with showing defensive qualities, so a bit of a flight to quality, really. And if we take a longer term horizon, we see a similar phenomenon, and we now have over 10 years of history for a lot of those in the ESG indices. For equities, our risk model shows that a lot of that outperformance is attributable mainly to equity style, but ESG as a factor or as a criteria is a very strong contributor, followed by volatility and better quality of highest ESG rated companies. And that outperformance was consistent across asset classes with fixed income, ESG fixed income, corporate indices, for example, displaying excess returns. So in terms of the experience in creating ESG indices and working with our clients, so we typically work with both sell side and buy side in Asia Pacific to design indices that meet the needs and objectives of an investors when it comes to the ESG. And this could include, getting higher exposure to high quality ESG companies with the view of maximizing performance, of reducing financial risk. It could also be looking at reducing exposure to controversial companies and headline risk, avoiding companies that have breached global norms, been involved in scandals and corporate frauds. And unfortunately, we do see this case is an incident on a regular basis, one of them being Wirecard. Another approach that we see frequently in Asia Pacific is the need to have an impact by incorporating, for example, gender diversity into an ESG index design, or looking at capturing climate-related investment opportunities such as wind and solar energy. So we've had a number of quite successful collaborations with these indices, with private banks and creators of structured products in the regions. And some of those related strategies have performed really well. So we definitely see lots more client interest. And then maybe a last point on the ability to localize. I think in general, for use in structured products, we often create customized indices, tapping into our experience in creating indices, our standard indices, but also into a broad set of ESG and climate data, sometimes in combination with factors or thematic. So a lot of tailor-made indices anyway, and thus that gives us the ability to adapt our offering to local needs.
Hello. Can you hear me?
Yes, Isabel, we can hear you. All good.
So sorry for that. Would you like me to follow on, or?
Yes, please, if you would, Isabel, if you could follow on.
Thank you very much, Dan. So I wanted to say, thus far I've not experienced that we'll need more performance in Asia Pacific than elsewhere. It's rather that, like in other regions, we must show competitive products that cater to clients' financial and ESG priorities. And I'd say the uptake or the success of ESG indices and products, to your question, Dan, always relies on three factors. First, education or communication. Second is innovation. And third is customization. So just to explain a bit, education or communication is about taking the time to say what material ESG factors are and how they can be combined with financial performance, and of course, how they can be implemented in efficient ESG investment solutions to actually turn theory into practice. And here I'd say the difference I've seen in Asia is that they're leveraging the experience gained elsewhere to go up that education or adoption curve much faster. And to give a concrete illustration, at the quote Société Générale's positive impact notes, for example, these are products that support the United Nations Positive Impact Finance Initiative because the bank commits to match the amount invested with an equivalent amount in loans to certified, audited positive impact projects, wind farms, public transportation, or hospitals, for example. And it's striking that we brought this product last year to Asia, and in 1 quarter only, they collected as much as what we've achieved during a whole first year of distribution in Europe back in 2017. The second factor was innovation, and here I've noted higher appetite from clients in APAC to explore new solutions. When other countries tend to focus on a single blockbuster product, in Asian countries, I've seen clients exploring a whole range of ESG solutions, from indices to funneling products to responsible cash deposits and positive impact notes, as I said. And, on the index, ESG index front, however, we must say a challenge is still that of data, because a quality ESG index relies on ESG selection of stocks, which in turn requires reliable and comprehensive reporting on ESG data by companies. And there is still a general less historical ESG data outside of Europe, which was a bit of an early adopter of ESG. And, for building and backtesting ESG indices of Asian stocks, it can be a challenge. The other challenge is where there is a stronger preference for short-dated products, because in truth, ESG generally delivers environmental or social benefits as well as outperformance, rather over the medium to long term. And that leads me to the last and third success factor, which I said was customization, because there is no one-size-fits-all ESG strategy. And as a product manufacturer, we must cater to local specificities in financial characteristics of products, and we must also adjust to local ESG priorities. And first example, as I said, is to focus on regional stocks or assets. But we must also account for local ESG, what I'd say is investment styles. For example, as done by the Japan's GPIF, we've seen Asian institutional clients focus a bit less on ESG exclusions and rather aim to remain a universal owner and tilt the weights to favor ESG leaders in their portfolios. And last, of course, a major driver of customization is local regulation. So for us, it's not about building a product range or even a matrix. It's three-dimensional with financial customization, ESG customization, and finally customization to local ESG rules. So a lot of work, but I believe banks are best place to add value by customizing and thus growing the market and the available offer instead of just competing with existing good ESG solutions.
Thank you. I want to touch on something you said there about on the data side, especially. Anyone who's been to an investment conference when we used to have those things, we'll see that ESG moved from being a fringe a few years ago into the main stage part of the investment presentations. And there has been some discussion about whether ESG is capturing things in hindsight or whether it's capturing things looking forward. And then we've moved into this kind of COVID-19 pandemic world. And Mark, I'd like to bring you into this discussion. As we move into this post-COVID world, the focus is going to be from the immediate panic, the liquidity issues that we saw around investing, and into something about more like solvency issues and good management, good governance. How do you think, or how can ESG indicators help us weed out those companies most exposed to the underappreciated risks? Is it going to be timely enough to catch the credit issues or even mismanagement? Some of the stuff that Isabel was talking about in terms of needing the data to capture what we're trying to capture.
Thank you, Gerard. Actually, I'm a big fan of ESG criteria, and that's something we are driving actively to our clients and to our selection process in DBS. However, on your questions, ESG indicators will be enough to catch credit issues, for instance? I would say no. I don't think ESG criteria becomes a silver bullet and will solve all the issues that all of us are facing when we select our investment. Typically, credit issues will have to be identified by usual financial analysis, okay? So ESG is not going to replace this analysis. ESG is already and will be a stronger layer on top of this analysis to detect certain risk, risk, environment risk, social risk, and impact risk, and the G risk, governance risk, which you mentioned when you talk about mismanagement. Yes, I think the G in particular is going to be very, very important. Unfortunately, is it timely? Is it not really? And it will be more timely in the future. But today, it's still, the data extra, the criteria, the rating are lagging behind. But it's better than nothing. Honestly, as a user, it's better to have this maybe late criteria than no criteria at all. Because at least you can use them for decision. A good example is Wirecard. Wirecard was extremely well rated by a lot of agencies on ESG, but their G apparently didn't. The fraud was basically a counter example. So again, I think post-COVID ESG criteria are getting more traction, more adoption, but they must be on the right reason. And again, for us, since we're still in the process of conveying the ESG message, ESG investing to our end clients, private clients, and including our staff sometimes, our portfolio managers, we don't want to confuse people and to be too ambitious and saying ESG will solve all your problems, and also the even problems you don't even think about today. Let's let's be very realistic. ESG is a new, very powerful layers on the top, but everyone still need to do is normal homework before using ESG criteria.
That's a very flexible outlook. And I'm just wondering if we have, another opinion as well. So, perhaps from Juliette and on the rating side, the data side, is there anything you'd like to add in thinking about these issues?
I think what Mark was saying is really interesting in terms of solvency, because you're right, what ESG is trying to achieve and measure is really the long-term sustainable solvency and sustainability of the company. So definitely, is the company business model or current operations are sustainable over a long-term period, and do they integrate enough ESG factors into their operation and business model to make it successful and sustainable? So definitely there's this kind of, that need to be taken into account when you use ESG data, and fully agree that it will not replace at all the financial analysis that any fund manager has to do regarding its investment, but it's really a new types of risks that need to be considered, and they're getting more and more important by the fund managers. So we moved, this ESG industry is still quite new, even if, for example, Visualize has been founded 20 years ago, but like some other providers, but the idea was to build as well, even if the methodology has been really stable and so on. The key point is how the companies are ready to disclose and to be transparent on their ESG data. And so it's moving from, it's a combination of quantitative data to qualitative data, just because some of the topics, especially for the social topic, it's quite difficult to have already standards that will list specific quantitative data or KPIs for social factors. So one of the key things to take into account that a data is nothing, and the quality of the data is nothing if company has not really to disclose properly and to be transparent on what they are doing exactly. And so company can there's all cases, but company can report less because they don't have data to report. They have no specific reporting in place, or they're just not willing to report on some aspect. And there's some specific topics that are usually less reported, such as, for example, the controversies. Company usually don't like to report on negative events. They try to not report on that, and they need to understand that it's business as usual to face some controversies. But the key point in this case is being responsive, implement some corrective measures. So and that's just an example. Some other underreported segment are, of course, some around social dialogue, or it's getting better, but supply chain, there's still a lot of difficulties to get proper data, human rights, taxes as well. So this is the key, this is a mix of being ready to report, being ready and to have the right data, and how the investor will use it. Maybe I just want to add some points regarding COVID, because it was the beginning of your question. Does the COVID, now we are getting more like into a solvency and long-term approach than just a crisis approach about liquidity. What we did realize that some specific ESG factors and criteria that are during the time of the COVID are really indicative of the resilience to the long-term operational impact of the pandemics. And so we have been able actually to rank companies about the ones that are better equipped to sustain this crisis period and this pandemic, and some other based on some specific dozen and ESG criteria. So it's important for company to bear that in mind, to be able to capture that, and as well to disclose that and communicate that at the end to the investment and fund managers, so they can take that into account in their investment decision process.
Yeah, let's stick with that theme for a second, because you've touched on some more great topics there, especially in in disclosure, when we're seeing even in the simple things, when items start to go the other way that companies expect, sometimes the disclosure isn't as forthcoming as it should be on that subject. And I think that really highlights what people are looking for in the future, that we're moving from this ESG 1.0 into a, I don't know, let's call it 2.0, where it's a more holistic approach and a holistic review of what ESG is, which means it's adopting a whole new nomenclature. It's going from just being about ES and G to intangible risk, or risks that we can't quantify necessarily with items on the financial statements. So if we can maybe stick from a data perspective, Christine, if we think about the reporting standards, the common nomenclature, these are viewed by some as an obstacle, I would say, to more widespread adoption of ESG, because we're not quite sure that everybody's looking at the same thing. How do you believe that, and how are we moving past that, and how is the situation in Asia Pacific when it comes to getting a more common vernacular?
Absolutely, I do believe in that. So in Asia Pacific, like elsewhere, standards and transparency are important, in terms of ESG, and they can facilitate sustainable investing. In fact, they're critical to shift assets toward more sustainable investment options. There's an example in Asia with Hong Kong that's looking at the creation of STAGE, the Sustainable and Green Exchange, and they're looking at exactly that to provide a lens and a list, kind of a framework to identify ESG and climate-friendly investment options. So more generally, yeah, standards are important. They create transparency. They enable comparability of funds, of indices. They enable investors to select an ESG index or an ESG fund or strategy that is suitable for them. So perhaps we could take the example of Europe, where the regulator has amended the European benchmark regulation. And by the end of the year, benchmark administrators, MSCI and others, would be required to disclose a set of ESG metrics for benchmarks. Those metrics include things like the ESG score, the carbon intensity. So they are either aggregate ESG metrics, or they are environmental, social, or governance metrics. So the EU has come up with that set of metrics to help provide that standardization. And the metrics are globally relevant, by the way, they're not European in nature. So this is a great step towards providing that standard and common nomenclature. And by the way, we now disclose all those metrics on our website. We've also created fund reporting tools that align with those European ESG metrics for investors to assess whether a fund, how funds look like through that lens. So Asia could probably take inspiration from what other regions are doing, including Europe, see what works, what does not, try and create maybe one regional standard and set of norms, hopefully stay away from too much complexity and the lack of harmonization. Europe has a whole variety of ESG fund labels, for example, and more are looking to arrive, and that makes it really difficult for creators of investment products, because they're having to tick a lot of boxes to meet all those different labels. It creates complexity and maybe even confusion for the end investors. I would even say it could have adverse effects on sustainability investing unless they get their acts together to harmonize that a little bit more. So again, some good lessons from Europe for Asia, and definitely very important and critical to have that set of norms and standards to facilitate sustainable investing in the region.
And Juliette, from your perspective, would you agree with that from your viewpoint?
Yes, definitely. I think what's needed is homogenization. So there's a convergence in the standards, not necessarily a full alignment to all standards, but at least a convergence to make sure that we are speaking the same language, and comparability is making possible between companies' ESG data. and what the company would like to achieve and communicate on. So definitely taking the example of what's happening in Europe could be a good idea, because we have been a little bit ahead in terms of reporting and especially mandatory reporting. The granularity as well has to be taken into account when we speak about standardizations, granularity of the data, and ability to report on that. Because what is possible to report for one sector is maybe not adequate for one other sectors, or for one company to the other sector. So I guess standardization doesn't mean like if it should be everything the same, but it should be more like convergence on the main principle of reporting, with keeping in mind material issues by sectors and even by region, because this is key to as well for companies to be able to to match what they have to report on to what really is the reality of their business and their operations.
Great. And I want to build on that theme for a second, because we talked about the standardization and the view that we need to have some common language in Asia Pacific and follow on from Europe a bit. And there's an interesting aspect here in that there was some research done at MIT's Sloan School of Business called Aggregate Confusion, looking at the differences between ratings and ratings companies and how that might change. If we think about this from credit risk, for example, tangible risk, when we look at the differences between rating providers, the correlations are in the high upper 90s. They're very correlated, so the market trusts these agencies, but on the flip side of that is in 2008, they all got it wrong. The correlation among ESG raters is much lower. And the ratings actually have some pretty stark differences in different companies. Some can be rated top and bottom quartile differences, for example. But a lot of that is due to the way, not the way they're looking at the company, but the way they're aggregating that all together. Is this aspect a roadblock to adoption, or is it something that we should embrace as an important differentiation and perspective? Maybe Christine, we can start with you there.
Sure. So that question comes up frequently. So it's critical. So I think the variety of ESG rating models and approaches is a reflection of the many ways of doing ESG and investors' preferences. And I think that will continue to be. So the variety in itself is not negative. What is negative and harmful is probably a lack of transparency and robustness of those ESG rating models. And so if we take transparency first, which is very important, so that investors can choose an ESG rating approach and methodology that best suits their objectives. It's essential, for example, to understand the methodology underlying an ESG rating. Are the ESG scores industry relative, or are they an absolute score? What are the sources of the data? Is it only based on questionnaires, or is it also taking into account alternative data sources? Is your ESG rating provider collecting information from a large number of those sources? And is the ESG scoring focusing on the most relevant and financially material issues for each industry? And in APAC, we see a lot of interest for that, financial materiality. And that's driving demand for ESG indices and related investment products, as well as avoiding controversies. So in the case of MSCI, because that's what I can talk about, the rating focuses on the most relevant ESG issues for a given industry, assesses a company's exposure to risk, ESG risks, and how it's handling those ESG risks. And it's been the case for years, and we have a 13-year track record with this ESG rating. And the chart that you're seeing in front of you is an extract from a recent paper that our research published. And what they found out was that the aggregate ESG score outperforms all three individual pillar scores of E, S, and G. And so what that shows is that a careful assessment of industry-specific issues and the weighting of E, S, and G in an aggregate score is really important and critical. And in this case, it's been adding value. So again, I think if we, going back to your initial question, I think what's required is transparency and then best practices on ESG rating. So a focus on materiality, an element of forward-looking with an assessment of how the company is managing future risks, such as regulation and sort of carbon tax, for example, robust data and models, transparency, and then a track record.
Thank you. And Mark, how does that sit with you from a product perspective?
Well, I think for us, having a benchmark is very important, and having a convergence and a strong correlation between the different methodology and the different agencies would be also very important for adoption of more by broader participants. I mean, again, just to summarize, we use the ESG rating, and actually we use the MSCI ESG rating to basically to select the products, to rate all the products we select, and also to rate all the products our clients have in their portfolio. And we engage our clients on the single product rating, bonds, funds, and equities, and because we want, at this stage, we want them to adopt this approach and understand what ESG investing is about. And we give them this rating so they can make up their own decision, right? So for us, it's very important to have something that we can, which is reliable. That if your clients come back, say, yeah, but another agency is rating this company differently. How do you justify? Okay, fine. We say that's why we provide it for informationally at this stage, because there's no benchmark yet, and we hope to have benchmark. And I think a lot of on the sales side where we are distribution, our life will be much easier if we have emergent of benchmark or 2 or 3 like it is in the credit rating business, Fitch, Moody's, and S&P's. That will make our life easier. It will probably simplify. I mean, from a technical point of view, analytic point of view, it's we on our side we want something simple. We're not sure it's going to be achievable in a short period of time, but that's what we need. Again, for us, the target is retail clients, is private investors, private clients, not institutional clients, all right? We want them to adopt this. Having this convergence between our agencies will be very important. But at the end, we accept that today there is this divergence. We accept that there is different methodologies. And again, for us, it was more important to start somewhere and adopt one, okay, with weakness and strengths, but then waiting 2 or 3 years to have a more clear visibility on which one will be the benchmark, or which companies will basically read. So we prefer to start earlier and communicating it to our clients on an information basis only. I think that's what's really motivated us in this approach.
Thank you, and that's I think a great way to look at that issue. And I've got maybe 2 more points here before we take some questions from the audience. The first one is, Julia, if you don't mind, I would like to start with you on this one. How do you think about the issues of actually measuring what's important when it comes to ESG? We've talked a lot about the overall data issues, the benchmark issues, et cetera. But when it just comes down to what we're measuring, for example, the levels or the change, how do you think about capturing what we want to capture? Do we want to punish good behavior, even if it's incremental from a poor position? Or do we want to reward bad behavior, even if it's a position that has been historically strong, if you know what I mean? Levels and change, I think, are an important topic when it comes to what do we want to buy and sell in the ESG world.
Sorry, I was on mute. So I agree with your point, but I think I will start back with point of Mark saying about the data and the fact that first we need to have data to be able to be able to wear judgment, and the role of ESG provider is not of course is via the consolidation of the score. It will give a ranking of company based on their overall ESG data, but you're right, at the end each investor will have his own views and his own investment style. So some will be willing to have put more weight on environmental topics, and in this case they will get more granularity on environmental, and they will use more weight in the overall ESG score on the environmental data. Some will put more emphasis on the social part, and some other will consider that without the governance is the first one to be really more relevant, and they will put a weight on, I don't know, maybe let's say 60% on the government score, and only 15% and 15% on the environmental and social score. So at the end, we cannot, the ESG ratings will not capture everything that the investor would like to achieve, and all investment policies and strategy that can be delivered. This is really a tool for investors to be able to drive their investments and to get as well, first ideas on screening. And one, if you go back like 20 years ago, the ESG started really for screening purposes, negative screening. So it was more on the bad, as you could mention, on the bad company, because they were doing badly in one of the 3 pillars, they were doing badly in one of the sectors, and so on. So from this negative screening, where it was putting something on negative on some company, we are today really evolving to more words like a balanced view, and being able to articulate the positive and the negative for each company regarding E, S, and G. And that's why it's now going to more concept about positive impact and so on. And one thing that is important in this to understand as well is you've got this positive impact, which in a way is probably more important that do your company is good or bad in one specific criteria, in one specific sector. What investor would like to see and would like to measure is what will be the impact of your company overall, and how they will, amend or correct or change their strategy towards a more sustainable or impactful one. So that's why it's important as well, whenever even you do a screening and a negative screening on good and bad company based on the specific criteria, it's important not to exclude any sectors and not to exclude any companies. Any companies can be in a really negative sector, environmental sector, for example, because of its negative environmental contribution, but could have a good, positive policy in terms of governance or leadership and social. So overall, what would be the impact and the positive impact or the positive expected impact from what the company is trying to achieve? So this is kind of a general view that it's really tool at the end for investor to decide where they want to put their emphasis and what they want to achieve. That's why some of our largest clients and investors are not using only one data provider, to come back to your previous question, but they will use a combination of some, and they will do their own assessment, or at the end their own ESG consolidated score, because they will put some different weights that will be a more reflection on their own strategy.
That's yeah. We need the data. We need the flexibility. We need to allow clients and customers who are using this to be able to achieve their goals through different perspectives. That's right. And I think that we're certainly seeing more of that. And perhaps Isabel, can you anything to add in terms of risk or otherwise on that subject?
Yeah, sure. Thank you. Just a quick follow-up, and it's a great question, I think, of level versus change, because indeed measuring ESG change has gained popularity in the recent year. I'd say first because investors are increasingly aware that there can be more impact in greening what's brown, to make it short, than further greening what's already green. And this could, for example, explain the recent attention to transition bonds, which support activities in transition, and not only those that are already green. And of course, there is key to independently measure and verify the actual progress or transition. So there's a do-good element in paying attention to change, but there's also a do-well element to it when you combine level and change, so ESG performance and improvement. And here, because figures speak louder than words, I'll just quote from a paper published last year by Société Générale's ESG Research. They selected the top 30% of the ESG ratings for each sector, and then further selected a fifth that also enjoyed positive momentum on ESG ratings. And they found that this basket generated a cumulative outperformance of 23.5%. Versus the broad European benchmark from March 2013 to 2018, so a long track record. And finally, to turn studies into reality, I can quote the example of an emerging market ESG trend or momentum index that we traded with an asset manager. So definitely traction for ESG change here.
Thank you for that. And again, very, very good points on how it applies to performance as well. And the last subject I want to touch on here is that most of the ESG world, and most of really what we're talking about, tends to be initially in that public market, especially public equity space. Of course, we've discussed about green bonds, transition into the fixed income world more. But one of the newest areas that ESG is being applied to is the private asset space. Private assets, of course, are a very large part of the Asian investing universe. And the question is, is the technology there? Do we have the tools, maybe outside of web scraping for news articles? Do we have the tools and the cooperation with private investments and private funds so that the rating agencies and evaluators can have more insight into what's going on behind the curtain? And maybe, Mark, as from your perspective, how do you see that?
Yes, well, I mean, that's a very, 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 very interesting question, actually, because, yeah, it's true, like we have been more and more involved the past few years in private equity, private debt, also real estate, private investment with our clients, wealth clients, ultra net worth clients in particular. And I would say, when clients want to take into consideration ESG criteria to invest, it doesn't matter whether the asset is public or private. Okay, so if there's demand, clients will ask, what about the ESG? Unfortunately, on the private asset side, in particular in Asia, it is very difficult, I would say, but I mean, Christine or Isabel will comment probably, will be difficult to get basically the data, the tools on these assets, because there's no disclosure. They are by definition private, and they don't disclose much. Also, Asia compared to Europe and US in terms of, I mean, even on the listed public companies extra, the coverage by agency on the ESG rating, for instance, is still not complete. So meaning we, as an Asian bank ourselves, we are still trying to try to find what is the rating of certain issuer for bonds or companies, listed companies, because we have Asian clients and they would like to have this kind of rating. So again, and I would say, first thing first, maybe to make sure like all the public sectors, all the public assets are rated, and then after having a rating process to rate the private sector. Just one last thing to add also on this. I think we had also clients investing in the private sector who are very, very involved in the S, meaning on the social and the impact investing. Okay, that's what different clients they are looking. It's at the border between philanthropy and ESG investing. Okay, so they are looking for performance. On the same time, they have a priority to do something very much impacting. And what they need on this, they need measurement of the impact, okay, on these investments. That's what really they want and they need. And that's something besides just the initial assessment of the potential impact of the investment. They want a follow-up and they want ongoing impact measurement to make sure that what their investment is basically producing at least the impact they were expecting.
Thank you. And let's see, I think we just probably have for maybe one more perspective. Isabel, I'll give you the final word if you have some comment on the private asset side as well, if you have an answer there.
Sure. I mean, very quickly, because I fully agree with all of what was just said. And I just quickly follow up on what I answered earlier concerning a general higher appetite for innovation and risk in APAC, where the return is right, of course. And we've seen indeed that Asian investors, and mostly institutions or high net worth, were much more prepared to look at illiquid ESG investments, for example, private debt. And I personally think it's great news because these investments deliver maximum additional environmental or social impacts to be measured, as was said. Also, it's a space where I feel banks can add value by combining their origination and distribution capabilities to source the right ESG loans and distribute them in products that will not only have the right risk return, but also the right impact. And as a conclusion, we're now moving from a twofold world risk return objective to a threefold objective now. We need to achieve the right risk, return, and impact levels.
Thank you. Thank you all for your great answers and perspectives on these topics. And over the course of this discussion, we've had a few questions that have come in. What I'll do here is maybe I'll read one out. I can answer the first one from my perspective, and if there's somebody else, one of the panelists as well, would like to as well, we can. The first question is, as an investor, I want performance. Is ESG more of a risk management type of investment? Can ESG be used in opportunistic investments? And look, I think this is a great question. And ESG, I think we would all agree on the panelists, is evolving very rapidly. And it started as one thing many years ago, and it has turned into something else, that it is a risk management tool. It is a way to get expressions in your portfolio of the type of investments that you want and feel comfortable with. But also, there is a tremendous amount of research now that this isn't just about negative exclusion, but it's about positive inclusion and holistic investing in the stories that should perform better over the long term because they are aligned with what society cares about. And I think that that's a very important factor about the performance of ESG. If, for example, we look at the carbon factor, and we can look at within sectors, not just about energy versus banks because one uses more carbon than another. But if we look at within a sector like the materials sector and see, do investors actually reward companies that have lower carbon usage? And we can view that through time, through the United States and through Europe. The lower carbon factor was actually providing better returns over time until a certain point. And it was until 2016 we started to see a divergence in the performance, and the US low carbon started to fall. And I think we might be able to understand why that might be, because at the time of 2016 we started to see a re-rating of what was important in US society about low carbon. And so it's not just about, can I find the right factor? It's about identifying the factors for risk management and for performance that we believe will be important to society investors going forward. And I'll also leave it, if there's someone else on the panel that would like to touch on that.
I think just to add on that, opportunistic investment is not incompatible with sustainable investment. So it's something that should not be opposable, and is something that can be together. Governance has been part of what shareholders were looking at for many years, just because it addressed issues to the shareholders, and ESG just explained what has to be looked at by other stakeholders behind the governance part. So starting by governance, but definitely going to more global and wider scope for the investment.
Thank you. And there's another follow-on. I think that follows to your point that you've just made, and that is, someone has asked the question that one of the aspects that underpins all of these points, whether it's the innovation, the data analytics, it's the human capital requirements. If we don't have the right people in place to implement changes, how can the businesses themselves hope to implement ESG, whether it's the asset owners, wealth managers, the banks? How do firms overcome this difficulty of getting the right people into place? And again, I think that this is happening slowly as a matter of firms are realizing that this is important, and it's important for their own performance and desirability as a business, as a firm to do business with, to have these changes into place. Of course, there's a cost to it, but the idea is that the cost is rewarded. I was reading another great piece of research at Harvard Business School from George Serafim, which many people might know, who was talking about some research they did on the human capital side, that a great predictor of how well companies would do would be how well connected the middle management layer was to the purpose of the business. And I find that fascinating, that senior managers tend to know what they're doing and workers tend to know what they're doing, but there's this middle management layer that can sometimes be seen as administrators of of a process without quite being connected to the purpose of the company. And companies that have shown a strong connection to purpose from middle management actually were much more successful in return on equity and in overall share firm performance. So I think that this is another question about, as companies realize the importance, the value that this brings, that they will allocate more resources going forward. And again, I'll see if anyone else on the panel would like to add anything. And okay, so the last question we have before we close, we have a question on ESG indices. New ESG indices are being created in combinations with custom strategies. Is there a danger of adding unnecessary complexity to the ESG and the underlyings? Maybe Christine, is that one you might want to touch on?
Yes, I can take that. So the first point is that I think the complexity of an index is really up to each client and investor to determine. And then the second point is that what we're seeing, and structured products is a good example, is we're seeing ESG being a way to enhance strategies with ESG as a filter. For example, a client may have a strategy with, I don't know, a high dividend yield or low volatility, and they wish to enhance that with an ESG filter. So selecting companies that have higher ESG ratings or performance and apply their low vol strategy on top of that. So that's one way to do it. And then another thing we're seeing is overlays. You know, for example, clients have factor strategies and they wish to improve the ESG or the climate profile of their existing strategy by using ESG as a way to enhance that. And then, of course, you have pure play ESG strategies, which only use ESG, like, and these indices include, you know, ESG leaders and other approaches. So again, I think the complexity is really up to each client. And rather than looking at ESG as something that adds complexity, I think it's just a way to enhance strategies and indices.
Thank you. Thank you very much for that. And I think we've come to the end of our time here. And I just wanted to thank the panel again for their fantastic insights and for all their comments on these questions. And this is a subject that I think we will all agree that will be more and more important to the investment world and to firm management as we move forward here, and especially out of the current pandemic and issues that we're seeing. So thank you again for joining, and thanks very much to the panel and to SRP.
Thank you.
Thanks all. Thank you.